So a very strong top 40 index with a few exceptions. In today's session, we're up 1%.
In the afternoon, yes.
Yeah.
We certainly start off the day on a negative footing, following on really from Asia and I think taking the cue from Europe and a lot of concerns there. But I think those US numbers that came out, those retail sales and the PPI, both better than expected. I think that certainly gave the market quite a push. I'm a bit surprised to see the Dow down at the moment, although, you know, obviously there's still a long trading session ahead for them. But interesting when you look at the currency movements in particular, obviously the European weighing on the market, and we saw the euro weaken against the dollar. Now, of course, that stronger dollar that we've seen over the last couple of weeks must have helped the PPI in particular in the US. That strengthening of their currency certainly helping to reduce the PPI from 6.9% to 5.9%, lower than expected. And yeah, certainly the picture in US looks much better than
Europe. And if we actually start seeing a slower PPI growth in the US, and that perhaps means more stimulus down the line, and if CPI starts to stabilize as well.
Well, I think at this stage, I think there's a lot of focus on the US to try and sort of pull us through this potentially recessionary period, because I think the numbers out from EU was very concerning today. I think the IMF numbers that were reduced just recently will probably have to be pulled back even further. And if you look at Germany and France being the two biggest economies in that region, and both of them paltry growth, with several of those regions, those countries in the region actually officially in recession.
Do you think that the market has priced in a potential recession at this stage, because earnings are not looking bad in South Africa?
No, they're not. You see, this is that disconnect between the economics and the real economy and the financial economy. Yeah. So we're actually finding that a lot of companies are able to cope very well with these very poor conditions. I think we saw several of our own companies with results today that shows management that actually cope very well with difficult circumstances. So certainly the financials of the companies look much better. We see that in the US even more so, but the economy on the ground not looking good at all.
Let's quickly look at top 40. Implats is up 2.7%. We actually had a price target downgrade by Goldman Sachs for Impala Platinum and Anglo Platinum as well. I mentioned Johnson Matthey was talking about $1,800 a fine ounce by the end of this year.
Well, you know, this is where platinum is mined and where platinum comes from. So whenever you see any news headlines on the platinum price, it will definitely translate into your companies. And we saw some weakness in the rand dollar today as well. So not surprising, I think, to see both those companies up on the day.
Kumba is down over 1%. We had MTN losing around 1%. A pretty mixed picture when it came to the bottom of the top 40.
You know, when I look at the iron ore and Kumba in particular, and I see what's been happening in China in these last couple of days with some of your American banks selling their big stakes in the Chinese banks. The most recent one this morning, Bank of America selling Chinese Construction Bank, and they are selling it back to the Chinese. So it's those sovereign wealth funds that are really buying it, really indicating that the banking scenario in China is very, very fragile. Now, that necessarily could imply a pullback in terms of China, and I think that obviously will be seen most in your base metal prices and in the likes of iron ore.
Are you pro having resource exposure right now?
Absolutely. You need to be exposed to everything as far as I'm concerned. You know, this is
financials,
everything. You need to be as diversified as you possibly can, because the person who can actually definitively say where we are going next or what's going to be the next up or the next down, well, good for him or her.
MTN down 1% at 135 Rand.
You know, difficult to read specifically into MTN itself. One of the things that I found interesting in Reunert's results, you know, about 2/3 of that came from Nashua Mobile, very much sell driven. So although the consumer is under duress, we see these more defensive counters actually performing quite well in terms of the consumer space.
Reunert, so would you say is that a buy for you as well?
For me, yes. I was very pleased to see their results. Also very nice there to see the extent of the cash that they've got. They managed to raise the dividends, and they spent more than 1.1 billion rand on share buybacks. Now, obviously, that's very good for the per share numbers. But I think this is exactly the sort of company where I'm saying, you know, the set of management that actually do very well in very difficult economic times.
Definitely stocks under pressure. We saw headline earnings per share coming under pressure, but order book is starting to grow.
Exactly.
And that is good news. But the question is margins within that order book.
Absolutely, because
really
it's the cost pressure. Because we saw them being able to raise their revenue this year or this reporting period, but it was the profit line, the cost line in particular, that pushed down the profit line. And I think that's really the concern. And obviously there were some restructuring costs involved in that as well. But labour costs remain a major problem. And then, of course, the electricity costs.
And tell me, when you say diversified, does that include construction stocks as well?
maybe I'll build on my construction portfolio at this stage.
Mr. Price, headline earnings per share for the first half expected to be up around 22% or so.
excellent set of results from Mr. Price, really. You know, if you consider where the consumer is, I think Mr. Price is so perfectly positioned in the lower end of the market, but selling themselves as a premium brand to a large extent. And I think we see this in terms of their numbers. Another share buyback there, also over 220 million rand spent on share buybacks by Mr. Price. So, you know, good cash on the balance sheet, great set of results,
okay,
really.
I said expected, they actually are out with results, and we also saw
Yes.
quite a nice dividend coming through from the company as well.
Yes.
A buy for you, Mr. Price, at this point?
You know, it'll be about valuations. These are the sort of counters
always
that
look expensive.
Exactly.
Nerina.
You need to buy them on the dip. So when there's like a negative, you know, when the tide is going out, those are the ones that you pick up.
Tiger Brands out with the trading update. Full-year headline earnings per share expected to be as much as 15% higher. Would you want exposure to Tiger Brands?
I think Tiger Brands is a great defensive play, and that's exactly also the sort of thing that you want to be exposed to in this very cyclical time. So yes, I do like Tiger Brands. The 15% is going to look much better in terms of overall numbers because of once-offs. So they were very good in terms of warning that, well, not warning, but actually highlighting that the HEPS numbers will be between 10 and 15%. I think under current conditions, very good set of numbers.
Few comments out of Giokos today. You know, just touching on some of them, loose monetary policy isn't really going to be the only thing that will assist in growth going forward. What do these companies actually need to restore sentiment, and that we can start seeing it being fed through into the share price?
You know, I think it is the companies that actually focus on what they can control rather than on what comes from exogenous factors that are the winners in this. So what they need to look for, you know, certainly stability is what we would all like to see, whether that be in the currency or an interest rate environment or whatever. But those are the exogenous factors. That's the external environment. So the companies should be inward focused in terms of what they do. Looking at what Giokos said today, she used that horrible word called stagflation, which is really a scary word for most economists.
And that's when you see growth, for example, 3%, and then inflation at around double that, so 6%.
Exactly. So you're looking at a slowing economic growth or below par economic growth, but rising inflation, which is very much the scenario on the cards for South Africa and many other parts of the world, Europe in particular also. And that's really the concerning issue. So where last week when they did not reduce rates, a lot of people thought, oh, well, it's to stimulate that they were expecting it to stimulate the economy. I think what she was saying is, you know what, let's just keep it where it is, but we're concerned about the increases in inflation at the same time. Not an easy balancing act for her.